why Asia will control the global economy by 2046. The global economic order, shaped and led by Western powers for more than 2 centuries, is approaching a historic turning point. If the 19th century belonged to the British Empire through the Industrial Revolution, and the 20th century belonged to the United States through the dominance of the US dollar and unparalleled soft power, then the next 2 decades will mark the rise of a new era, the Asian century. This is no longer a theoretical prediction or an optimistic aspiration. It is a measurable reality built upon profound shifts in capital flows, technological capabilities, and demographic structures. From the perspective of a macro financial analyst, Asia's rise toward commanding the global economy by 2046 is an inevitable trend, driven by the convergence of 3 fundamental forces: the internal strength of a massive consumer market, dominance over future-oriented technology supply chains, and the irreversible structural decline of Western economies. 1. The global consumption center, the power of demographics, and the exploding middle class. The first and most powerful foundation of Asia's future dominance is its population scale and the rapid expansion of its domestic consumer market. Asia is home to more than 4.7 billion people, accounting for roughly 60% of the world's population. However, the true financial significance lies not merely in the sheer size of this population, but in the speed at which its income structure is transforming. According to strategic analyses from the Asian Development Bank, the region is experiencing the largest middle-class expansion in human history. By 2030, Asia is expected to contribute nearly 3 billion people to the global middle class, representing more than 60% of the world's total middle-class population and vastly surpassing traditional markets such as North America and Europe. This expansion is being driven by 3 major growth engines: China, India, and the ASEAN bloc. Although China faces long-term demographic challenges associated with population aging, its GDP measured by purchasing power parity, PPP, surpassed that of the United States years ago and continues to account for more than 30% of annual global economic growth. Meanwhile, India is emerging as the world's fastest-growing major economy, consistently maintaining real GDP growth above 6 to 7% annually. Its greatest advantage is its demographic dividend, with a median age of approximately 28 years. ASEAN, led by dynamic economies such as Indonesia, Vietnam, the Philippines, and Malaysia, forms an economic community of more than 670 million people with rapidly rising purchasing power fueled by urbanization and economic development. The rise of Asia's middle class is fundamentally reshaping global investment behavior. In the past, Asian companies primarily manufactured goods for export to consumers in the United States and Europe. Today, as disposable incomes surge, Asian consumers themselves are becoming the ultimate destination of global value chains. This enormous domestic market creates a powerful gravitational force, compelling multinational corporations to relocate research centers, product development facilities, and strategic capital allocation decisions toward the East. For nations and corporations seeking growth over the next 2 decades, dependence on saturated Western markets will no longer be sufficient. Success will increasingly depend on understanding and serving consumers in New Delhi, Jakarta, Shanghai, and Ho Chi Minh City. Number 2, the fortress of technology and advanced manufacturing, when global supply chains become strategically controlled. If consumer demand forms the foundation, control over future technologies represents the crown that will enable Asia to shape the global economy. The era of natural resource dominance and low-cost labor has passed. The world is entering the 4th industrial revolution, where national power is increasingly measured by leadership in 3 strategic sectors: semiconductors, artificial intelligence, and electric vehicles linked to green energy. Across all 3 sectors, Asia is not merely leading. It holds near monopolistic positions in many of the most critical segments. Consider the semiconductor industry, the brain of the digital civilization. Asia currently controls more than 80% of global semiconductor manufacturing capacity. Taiwan, South Korea, and Japan possess the most advanced production technologies, which Western countries may require decades and hundreds of billions of dollars to replicate. Taiwan's TSMC alone commands more than 90% of the global market for manufacturing advanced chips below 5 nanometers, chips essential for supercomputers and cutting-edge AI systems developed in the United States. Any geopolitical disruption in the Taiwan Strait or on the Korean Peninsula could immediately paralyze industries ranging from automobile manufacturing and smartphones to defense systems across the Western world. The dominance becomes even more pronounced in electric vehicles and battery supply chains, the core engines of the global green transition. Chinese companies such as BYD and CATL currently control more than 60% of global lithium-ion battery production and dominate over 80% of supply chains for critical minerals, including cobalt, lithium, and graphite. Western governments have introduced extensive policy initiatives and subsidy programs, including the U.S. Inflation Reduction Act, IRA, in an effort to localize supply chains. Yet financial realities reveal that they still depend heavily on Asian intellectual property, refining capabilities, and manufacturing expertise to keep their factories operational. Asia has successfully evolved from a low-cost manufacturing hub into a high-tech fortress that sets technical standards and controls the production lifelines of the global economy. The structural decline of the West, aging populations, and the public debt trap. To understand why the center of global economic gravity is shifting eastward, it is necessary to compare Asia's rise with the macroeconomic realities confronting Western economies. While Asia remains filled with growth momentum, the United States and especially Europe face chronic structural challenges that are steadily eroding their long-term competitiveness. The two greatest burdens weighing on the West are demographic aging and unsustainable public debt. From a demographic perspective, most European Union countries, and Japan, which shares many Western-style economic characteristics despite being located in East Asia, have long passed the peak of their demographic dividend. Persistently low birth rates and rapid aging are shrinking working-age populations while simultaneously imposing enormous healthcare and social welfare costs on public budgets. The combination of labor shortages and rising operating costs has reduced Europe's potential GDP growth to a sluggish range of approximately 1% to 2% annually, pushing much of the continent into prolonged economic stagnation. Even more concerning is the public debt crisis. To sustain extensive welfare systems and stimulate economic activity through repeated crises, Western governments have increasingly relied on debt issuance. U.S. national debt has surpassed the staggering level of $34 trillion, equivalent to more than 120% of GDP. In Europe, major economies such as France and Italy continue to maintain debt-to-GDP ratios above 100%, levels widely regarded as alarming. From a financial perspective, record-high public debt combined with elevated interest rates creates a dangerous dynamic. Governments are forced to allocate growing portions of tax revenues toward debt servicing rather than investing in infrastructure, education, scientific research, or productivity-enhancing initiatives. This debt trap severely constrains policy flexibility and transforms many Western economies into aging, slower-moving systems that are increasingly vulnerable to global macroeconomic shocks. Expert conclusion: a new order emerging from the East. Looking at the broader global macroeconomic landscape, the shift of economic power from West to East over the next 2 decades is not a temporary phenomenon. It is the outcome of deep structural changes and decades of accumulated economic momentum. Asia possesses all the essential ingredients necessary to establish a new economic order. A vast consumer market powered by a vibrant middle class, dominant control over critical technology supply chains of the future, and substantial financial resources that are far less constrained by public debt burdens than those of many Western economies. However, this emerging influence does not mean Asia will simply replace the West in a mechanical transfer of power. Instead, the world is likely to evolve toward a multipolar economic system in which financial institutions, capital flows, and major strategic decisions are increasingly shaped by the interests and consensus of Asia's leading powers. For policymakers, business leaders, and global investors, recognizing and preparing for this eastward shift in economic gravity is no longer optional. It is essential for safeguarding prosperity and capital over the coming decades. The Asian century is no longer a forecast for the future. It is already unfolding before our eyes. The battle for geoeconomic balance. The Western Alliance seeks an escape from the trap of dependence on Asia. The emerging multipolar world order is taking shape at a pace faster than any Wall Street forecasting model. As the gravitational center of capital flows, manufacturing capacity and consumer spending power shifts irreversibly toward the east. Western capitals, from Washington and London to Brussels, are confronting a suffocating geopolitical reality. The strong rise of Asian actors in dominating semiconductor supply chains, controlling critical mineral resources of the green era, and capturing booming consumer markets has placed the United States and Europe in a defensive strategic position. If the past 2 centuries were defined by the West shaping the rules of the global system, the next 20 years will be an intense pursuit by North America and the European Union to find a new balance of power in order to avoid falling into a state of total dependence on Asia. This awakening is not taking place peacefully, but has been triggered by a series of systemic supply chain shocks. From the perspective of leading macro-strategic analysts, the West cannot and should not attempt to block Asia's natural development, a task that the Financial Times has assessed as economically impossible. Instead, North America and Europe must undertake a comprehensive internal overhaul, building new self-reliant technological fortresses, establishing friend-shoring trade networks, and unshackling the fiscal constraints that bind national strength. This is the only path for the West to preserve its independence and economic sovereignty in the new century. Number 1, repositioning the technology map, the semiconductor gamble, and the upstream supply chain. The first and most critical link in the Western counter-strategy is regaining control over the semiconductor industry, the lifeblood of the entire digital civilization and national defense systems. Heavy dependence on TSMC's megafabs in Taiwan and Samsung in South Korea has placed the West in a precarious position in terms of economic security. Aware of the risk of supply disruption at any moment due to geopolitical tensions in the Taiwan Strait, both the United States and the European Union have launched unprecedented fiscal measures to bring chip manufacturing capacity back across the ocean. In North America, the CHIPS and Science Act of the Washington administration, with direct funding exceeding $52 billion USD, has triggered a historic shift in capital flows. According to monitoring reports from the U.S. Semiconductor Industry Association, this wave has activated more than $200 billion USD in private investment, transforming states such as Arizona, Ohio, and Texas into massive construction sites for next-generation semiconductor megafactories. Giant corporations such as Intel, TSMC, and Samsung have been compelled to invest tens of billions of dollars to build advanced chip manufacturing facilities on U.S. soil in order to secure access to subsidies and maintain a stable supply chain for Western technology clients such as Apple, Nvidia, and Microsoft. Similarly, across the Atlantic, the European Union has not stood aside in this life-or-death competition. The European Chips Act has been passed with the ambitious goal of mobilizing over 43 billion euros in public and private investment to raise the EU's global semiconductor production share from below 10% today to at least 20% by 2030. Europeans understand that they can no longer remain purely consumers of Asian technology products. Attracting Intel factories to Germany and joint ventures between ST Microelectronics and Global Foundries in France are existential steps to secure chip supply for the automotive and high-end machinery industries, arguably the last remaining pillars of the European economy. However, building factories is only the visible layer of the iceberg. To truly balance power with Asia, the West must maximize and protect its monopoly in the upstream segments of the semiconductor value chain, where Asia has not yet fully replaced Western dominance. This includes high-end chip architecture design capabilities held by U.S. firms such as Nvidia, AMD, and Qualcomm, and especially the ultraviolet lithography systems monopolized by ASML from the Netherlands. ASML's lithography machines are the only systems in the world capable of etching ultra-fine circuits onto silicon wafers to produce sub-5 nanometer chips. By tightening export controls on these core upstream technologies to Asian markets through multilateral security alliances, the West can maintain a strategic lever, forcing Asian countries to adhere to international rules of conduct and preventing them from weaponizing manufacturing dominance as an instrument of economic coercion. 2. The friend-shoring alliance and the strategic minerals race. One of the most costly lessons the West has drawn from trade wars and geopolitical crises is the collapse of the illusion of a flat, fully globalized market in which goods move freely regardless of political value conflicts. Dependence on China for rare earth elements and key components for electric vehicle batteries has placed the West in a completely reactive position within the green transition. To break free from this constraint, leading economists at the Brookings Institution and the Council on Foreign Relations have proposed a landmark strategy: friend-shoring. At its core, friend-shoring involves relocating manufacturing and raw material supply chains away from geopolitically high-risk countries toward nations that share similar cultural values, political systems, and commitments to international law with the West. The United States and Europe recognize that they cannot independently produce and extract everything due to natural resource limitations and high labor costs. Therefore, building a new economic alliance network that includes close partners in Latin America, Africa, and strategically aligned countries in Southeast Asia and South Asia is key to risk diversification. In the race to control strategic minerals, the new oil of the 21st century, the West is aggressively advancing the Mineral Security Partnership, MSP, an alliance comprising the United States, Canada, the United Kingdom, Japan, and the European Union. The goal of the MSP is to mobilize public financial resources from development agencies and export-import banks to fund extraction and refining projects for lithium, cobalt, nickel, and rare earths in countries such as Australia, Chile, Canada, and resource-rich African states. This strategy aims to break China's dominance in mineral refining and ensure that Western electric vehicle and renewable energy manufacturers maintain access to a stable, clean, and politically independent supply of raw materials, free from export restrictions driven by geopolitical considerations in Beijing. At the same time, the West must leverage its superior innovation capacity to develop technological substitutes that reduce reliance on scarce minerals in future products. Leading research centers in Silicon Valley and European universities are investing billions of dollars into next-generation electric vehicle batteries, such as sodium-ion batteries and solid-state batteries that do not require cobalt or nickel. By accelerating breakthrough technologies, the West seeks to leapfrog existing supply chain constraints built over decades in Asia and ultimately reverse the balance of power in global green energy systems. 3. Fiscal rescue and educational transformation, unlocking internal resources. All technological counter-strategies and geopolitical alliances become meaningless if Western economies fail to resolve their internal structural weaknesses. To generate sufficient long-term financial capacity for the race against Asia, the United States and European countries must implement decisive fiscal reforms to escape the rapidly expanding sovereign debt trap. As public debt exceeds safe thresholds, governments lose policy flexibility, and national budgets become increasingly consumed by interest payments rather than investments in future-oriented infrastructure. The Economist argues that the West must courageously reform its welfare systems and public spending models toward greater efficiency and sustainability. This does not imply extreme austerity that harms vulnerable groups, but rather administrative optimization, reduction of bureaucratic inefficiencies, and full-scale digital transformation of public services, measures that could save hundreds of billions of dollars annually. The resources freed from fiscal reform should be strategically redirected into sovereign venture capital funds, supporting early-stage fundamental research projects that private investors typically avoid due to high risk. Beyond financial challenges, the West's most critical weakness compared to Asia in recent years has been the decline in both quantity and quality of talent in science, technology, engineering, and mathematics, STEM. While universities in China and India produce millions of highly skilled engineers each year, Western education systems have increasingly shifted towards service-oriented and social science disciplines, creating a severe shortage of advanced technical labor for high-end manufacturing industries. To reverse this trend, North America and Europe must undertake a comprehensive national education reform. Governments need to work closely with major technology corporations to fund scholarships, establish new generation vocational training centers, and encourage younger generations to return to laboratories, precision engineering, material science, and low-level AI programming. The West must also preserve and maximize its greatest competitive advantage, its cultural soft power, and world-leading elite universities, continuing to attract and retain top global talent, including from Asia itself, turning them into a driving force for economic growth. Expert conclusion: coexistence in a multipolar balance. The global economic competition over the next 20 years is not a zero-sum game in which one side must be completely eliminated for the other to prevail. Asia's rise is an irreversible historical reality. But this does not mean the West must accept a fate of decline, dependency, or marginalization. The decisive actions taken by the United States and Europe in repositioning semiconductor supply chains, establishing friend-shoring alliances for strategic minerals, and reforming internal fiscal and educational structures are not aimed at isolation or the initiation of a new Cold War with Asia. The ultimate objective is to establish a stable counterbalancing position, a new global balance of power in geoeconomics. Only when the West demonstrates strong self-reliance, the ability to protect core technologies, and resilience against supply shocks, can the world operate within a stable multipolar order, where actors engage through mutual respect, cooperative development, and adherence to international law. This battle for geoeconomic balance will become one of the most defining chapters shaping the world for generations to come.